Hi, this is Steve Gorin. I'm going to provide a brief overview of the effective business income tax rates in light of the 2017 tax law changes. I'm going to go through a series of slides, and we're going to determine the annual effective income tax rate when a C corporation distributes all, half, or none of its earnings. And then after I'm done going through these, I will connect you with some resources in putting these effective annual rates into a larger strategic context. Now we're going to go to slide 2. Now on slide 2, we're going to talk about a corporation distributing all of its net income after income tax. So first of all, before I go through the slide, I want to explain this parenthetical in the upper right-hand corner. You'll see a reference here to Roman numeral 2E1A. Everything on the slide is explained in detail in supporting materials. And the very last slide in this presentation explains how you can get those supporting materials. So here we are illustrating a C corporation. A C corporation is a corporation that pays income tax on its own earnings. Now that's contrasted with an S corporation where the shareholders elect to pay taxes on the corporation's earnings and the corporation itself does not pay income tax. That's also contrasted with an entity taxed as a partnership, such as an LLC, where the owners also pay the income tax on the entity's earnings rather than the entity paying the tax. So the big deal for a C corporation, which pays tax on its own earnings, is that 2017 tax reform reduced the top rate from 35% to a flat rate of 21%. Now, in addition to paying federal income tax, a C corporation will generally pay state income tax. Now, some states don't impose any income tax, and some states impose a very large income tax. But for purposes of this presentation, we're going to assume that the corporation pays a 5% state income tax, and also that when it distributes its earnings, its shareholders will pay a 5% income tax on those dividends. So we have an effective rate inside the C corporation of 26%, which consists of 21% federal income tax and 5% state income taxes. So if we take that 26% and multiply it by the $100,000 of taxable income before income tax, we get a $26,000 corporate income tax. So subtracting that $26,000 from the $100,000 corporate taxable income, we have $74,000 of net income after income tax. On this particular slide, we're assuming that the entire $74,000 of earnings is distributed to the shareholders. Now we're going to apply the tax rate on the dividends at the highest tax rate that would apply to an individual. Now, dividends from a C corporation are generally taxed at the same tax rate as long-term capital gains. And on this slide, we have a 28.8% rate being applied for the top taxpayer, and that consists of three things. First of all, a 20% federal income tax rate, a 3.8% net investment income tax rate, which I'll address in a moment, and a 5% state income tax rate. So 20% federal income tax plus 3.8% net investment income tax plus 5% state equals 28.8%. Now, this 3.8% net investment income tax is a special federal tax that's imposed to fund the Affordable Care Act, which is also known as Obamacare. Now, you may recall that in 2017, the Republicans tried to repeal the Affordable Care Act. And along with it, they were going to repeal the net investment income tax. Now, the net investment income tax is not formally tied to the Affordable Care Act, but as a political matter, they tie the two together. So, just as an aside, this 3.8% net investment income tax, people would abbreviate that net investment income would be abbreviated NII. Now, for those of you who have seen the movie Monty Python and the Holy Grail, you'll see a skit of the knights who say, "Nee." And in that movie, "Nee" was a very bad curse word. And so 40 years ago when they had this movie, they knew that "Nee" would be a very bad word. So we have our 28.8% rate, which includes the "Nee," and that gets applied to the $74,000 dividend to come up with a tax of $21,312. So if we subtract that $21,312 tax from the $74,000 dividend, we see that the shareholder has $52,688 left over. So doing the bottom line math, the $100,000 has had an effective tax rate of just over 47.3% applied to it to reduce it to just under $53,000 left. Now on the right column, let's go through the numbers for an individual in a modest tax bracket. Now inside the C corporation, we don't care what the shareholders' tax rates are. There's going to be $74,000 left net after the corporation pays its income tax. Now I'm applying to that $74,000 on the right-hand side a 20% federal tax rate, and that consists of 15% capital gains. There's no net investment income tax on a moderate taxpayer, and then a 5% state income tax. So 15% tax rate for federal plus 5% state equals 20%. I take that 20%, multiply it by $74,000, and come up with $14,800 of federal and state income tax on that $74,000 dividend. So $74,000 minus $14,800 of federal and state income tax equals $59,200 left over in this shareholder's hands. So if you take our original $100,000 and apply a 40.8% tax rate to that, it comes out to that $59,200. So we're gonna take that 40.8% tax rate and we're gonna show it on a future slide. So this ends slide 2, and now we're going to go to slide 3. So here on slide 3, we're going to show when you distribute only half of the corporate net income after income tax to the shareholders. So this is a little bit of a busier slide than slide 2. But the first 3 rows are all the same. The corporation earns $100,000. It pays $26,000 of federal and state income tax, and has $74,000 left over. Now here we're going to distribute only half of that net earnings to the shareholders. So half of $74,000 is $37,000. So the shareholders receive a $37,000 dividend, and then we apply a 28.8% rate to that. And if you multiply 37,000 times 28.8%, you come up with $10,656. Now, subtracting that $10,656 dividend tax from the $37,000 dividend, we come up with $26,344 net cash to the owners. Now, that's the cash in the owner's hands, but remember, the corporation retained half of that dividend, or $37,000. So if we take the $26,344 that the owners got net after tax and the $37,000 that were reinvested, we come up with $63,344 net after income tax combined between the corporation and the shareholders. So if you subtract that $63,344 from the $100,000, that comes out with an effective tax rate of about 36 2/3%. So moving to the right-hand side of this slide, again, the first three rows are $74,000 of corporate net income after income tax. We're distributing $37,000, half of that $74,000, to our shareholders. This time our shareholders are in the modest tax rate. We're going to apply the 20% rate to that. So 20% of $37,000 is $7,400. We subtract the $7,400 from the $37,000 to come up with $29,600 in the shareholders' hands. So that's their $37,000 dividend after paying federal and state income tax on it. Now again, remember this is only the one half that was distributed to the shareholders. The corporation reinvested the remaining one half. So there's $37,000 that got reinvested inside the corporation. If we add that to the $29,600 that the shareholders received net after income tax, we come up with an effective rate of $66,600. So that's our effective tax, and the effective tax rate on that is about a 1/3 tax rate. $100,000 times a third will give you $33,000 or so in taxes to come up with the $66,600, and that is summarized on a later slide. Now we're going to move on to slide 4. So on slide 4, we're going to assume that the corporation distributes none of its corporate income after income taxes. And we already did that calculation in the prior slides. There's a 26% effective tax rate. Now, I frequently represent people in their estate planning, although I do pure income tax planning as well. But in the estate planning scenario, we're constantly advising people regarding what the effects are on the beneficiaries. And for those of you who have ever dealt with beneficiaries, they have only one thing in mind. And for that one thing they have in mind, I'm going to channel the movie Jerry Maguire. And if you recall the movie Jerry Maguire was a sports agent, and he got fired from his job, and all of his clients stayed with his old firm except for one, played by Cuba Gooding Jr. And that particular client who was left had only one simple request: show me the money. And so even though we're saying we're going to reinvest all of our earnings, that might not necessarily be practical. So we do have a 26% rate here, but it may or may not be practical. Now let's go on to slide 5. Slide 5 is a summary of the prior 3 slides. So you can see for an individual in the top bracket, if the corporation distributes all of its net income after income tax, there's an effective rate of 47.3%. If it distributes half of the corporate net income after income tax, there's an effective annual rate of 36.7%. And if it distributes none of the corporate net income after income tax, then there's an effective rate of 26%. Now that annual rate is in some ways an illusion, because if the corporation is sold later on, those earnings are going to get taxed in the form of capital gain tax. There'll be an increased sale price because of those earnings, and there would be a gain on the sale of that stock. So that 47.3% is generally a pay me now or pay me later. And you can see similarly for somebody in the modest bracket, the rates are 40.8% if you distribute all of the earnings, 33.4% if you distribute half, 26% if you distribute none. Now, in separate resources, I describe the strategic issues involved in these decisions to distribute all, half, or none. how that compares to pass-through entities, whether you can actually distribute half all or none. With that 47.3% pay me now or pay me later, I'll also describe how true that really is and other strategic considerations. Now we're going to go on to slide 6. Slide 6 includes resources, and all of these are free. So the first bullet point, you can email me to get a fully searchable PDF of my business structuring materials, which includes walking through all of these prior slides, but doing it in written form. Now, I also have a free quarterly newsletter that includes the most recent version of this PDF if you find that it's useful. And completing that form at the indicated address would give you the PDF and the newsletter. And I also have a blog that's less technical that it doesn't really cover what's on this particular page, but it does get into some overall ideas. But the other resources that I have, each quarter I go through a few different topics, and on October 30th, I had a recording that talks about the effective tax rates for pass-throughs, and there's a special deduction that was enacted with the new tax law and discusses whether you're actually going to be able to use that deduction. I also have a webinar that I did on January 30th that goes through these rates and goes through the very strategic considerations of choosing a pass-through entity or a C corporation. And if you email me, I'm happy to send you a link to that. Or you can certainly go and find my webpage, and thompsoncoburn.com does have these webinars that I did on January 30th and October 30th available online 24/7 for free. So I hope that you found this useful and look forward to future contact with you.